Question 11. The Gordon growth model cannot be used to estimate intrinsic value if the associated company A is rapidly growing. So this sounds like it will be our answer. The Gordon growth model is typically more suitable for stable, mature companies that pay dividends and that are going to be growing those dividends over time. If a company is rapidly growing, they're typically not going to be paying dividends, or the dividend may not be enacted till further in the future, because when you're rapidly growing, you're putting most of your cash flows back into the business rather than paying out money to shareholders. And if the other reason is the Gordon growth model requires a stable single growth rate. So if a company is rapidly growing, it's probably not sustainable that they'll be able to continue that growth into the future. So we would need to use something like a two-stage model where maybe we have something like 20 or 30% growth for the next 5 years, and then we level off to 5-10% growth in perpetuity and start paying dividends. So the Gordon growth model will typically not be good for this type of company. Let's make sure we can rule out B and C though. B assumes a perpetual dividend growth rate. We can cross this off, since yes, this is an assumption of the Gordon growth model, and goes back to why it doesn't work well for A. If we're rapidly growing, we're not going to be able to assume that high growth rate into perpetuity. C retains a portion of its profits for reinvestment purposes. We can cross that off as well, since that's totally fine. Most companies are not going to pay out their whole cash flows as dividend, nor would we want them to. We want them to be able to reinvest into the business in some capacity. So all that said, we will stick with answer A. Question 12. The length of a company's operating cycle has increased in the current year. Which of the following statements most accurately justifies the reason for this increase? So when I think when looking at questions like this, it's not math oriented necessarily, but it's helpful to know the formula for this so that we can kind of determine whether the operating cycle increased or decreased. So operating cycle is going to be equal to number of days receivables plus number of days in inventory. So an increase in our operating cycle should correspond to either an increase in the number of days receivables or the number of days inventories. These are both positive sides on the side of the formula. So these going up will increase our operating cycle. So that in mind, let's look at these answers. A, the company's inventory balance has decreased. So if we have less inventory, that's going to lead to a decrease in the operating cycle according to the formula. So we can go ahead and rule that out. B, the company is taking advantage of early payment discounts. This is going to be related to payables, which is not a metric in the operating cycle. So I think we can go ahead and rule out B as well. C, the average number of days to collect payments from customers has increased. That is our number of days receivables. So that this is increased, so that's going to lead to an increase in the operating cycle, and essentially it means that we're just not getting cash as fast as we were before. So we'll go with answer C. Question 13. For one of her equity investments, investor Carol March has specified a good till canceled order, stop 120, limit 95 sell order. The original purchase price of her investment was $150. If the price of the stock declines below 120, March's good till cancel order will most likely A, not be executed, B, be executed, and her maximum loss will be $25, or C, be executed and her maximum loss will be $55. So for a good till canceled order, what this tells us, so the stop of 120, essentially we use these good till canceled orders to kind of limit our losses. So we're putting a stop at 120. So we're holding the stock at 50 or 150. If this 150 falls below 120, we're gonna sell basically. So once the stock falls below 150, we're gonna start selling our position, and then the limit 95 essentially says for a limit order, this means I will sell at $95 or greater. So once the stock falls below 120, we're gonna sell our whole position unless it falls below 95. So if we fall below 120, we will be executed, so we can go ahead and rule that out. And then we need to figure out what our maximum loss will be. So will it be $25 or $55? So if we hold it at 150, the most we can lose is going to be 150 minus our bottom limit order, which is 95. So we'll have 150 minus 95, which is 55. So we will go with the answer C. And I think B is if you subtracted 120 from 95. But that doesn't help us because we want to know what we hold the stock at or the investment at to kind of determine our loss. So that's what a good till canceled order is, and we will go with C. Question 14. Pedro Lee serves a broker-dealer firm and has negotiated with Grace Arnold, the CEO of Chemco Solutions, to sell her a significant holding of the company's stock. Lee apprehends that the order may be challenging to execute due to the size of the trade. The execution mechanism that Lee should utilize is most likely. So we've got a large trade. What's the best way to kind of execute this? So we've got A, broker markets, B, crossing networks, or C, over-the-counter markets. So we can cross off over-the-counter right away. So in over-the-counter markets, the dealers are going to be transacting typically on their own kind of book, so to speak. So they're going to be buying and selling securities, and they're usually not going to want to hold a large holding because it might be hard for them to kind of offload that. And typically the over-the-counter markets are going to be a little bit smaller. So they're taking on a lot of risk by buying a large trade or by helping execute a large trade. And so higher risk is going to lead to higher bid-ask spreads. And so the dealer would charge some premium for that. So that's probably not going to be the best way for them to execute. Crossing networks, these are usually going to be reliant on high volume, so large trades usually are not going to be a good option. So that leaves us with A, brokered markets, which I think we can confidently go with. On the brokered market side, different than the over-the-counter, the broker is matching up buyers and sellers, and they're typically pretty well connected with their buyers and sellers and kind of know what they're in the market for. So they can kind of use their connections to help Lee execute this large trade and maybe find some buyers on the other end that will be able to give them the pricing that they're looking for. So we'll go with A. Question 15. Jean Saunders has purchased a stock using 15 of her funds and 30 of borrowed funds. 1 month after making the investment, the stock falls by 15% in value. Her financing mix meets minimum margin requirements, the initial margin and unannualized return on the investment. Before considering the payment of fees and commissions is closest to. So our initial margin, that's going to be pretty straightforward. That's going to be, we have $15 and we were able to buy 45. So that's going to be calculated as our equity over total investment. So we'll have 15 divided by 15 plus 30, which gives us 0.33333 or 33%. So we've got 33% here, 33 here, but for C we have 50, so we can rule that out. And then for the return on investment, one simple way to do that, because we're not considering commissions and borrowing costs yet. So the straightforward way is just kind of multiply our return by our leverage. So our return is minus 15%, which is given. And then leverage is going to be total investment over our original equity, which is just the inverse of this initial margin formula. So we're given minus 0.45 or minus 45%. So for A, we have 22, so we can cross that off. And then B, we have minus 45% right here. And then another way to calculate that, let me pull in the ROI calculation. So what we'll do is we calculate the ending equity essentially. So our ending equity, we had $45 invested and we lost 15. So now we have $38.25 is the value of our investment. And so the value of our equity is the difference between the $30 we borrowed minus that 38.25. So our equity now is 8.25. and our starting equity was 15. So we just do the return calculation formula here. So we could do ending equity divided by beginning equity minus 1 gives us minus 0.45 as well. Answer B, question 16. A market's limit order book quotes the best bid and offer at 35 and 38 respectively. A limit buy order with a price of 36 is placed by a trader. The order will most likely A, make market. So when we make market, this would be if we placed a limit order at the bid. So if we placed a limit order, we placed our limit order at 30, a limit buy order at 36. If we placed our limit buy order at 35, we would make market. Since we're not contributing anything new, we're basically just like going at the same previous bid. So because we're above that, not at bid, we will not be making market. B, make a new market. This sounds like it will be our answer. Since it's a limit order between the bid and offer, it's not going to match any of the current seller offers, and therefore it's going to be kind of added to the order book and not executed. But this does make a market for other traders to potentially trade off of. So making a new market will likely be our answer. Let's make sure we can rule out C though. Fall behind the market. This is what happened if we placed the bid. We placed a bid of 36. If we placed the bid at 34 below this bid, that would be falling behind the market. So we can rule that out as well. Answer B. Question 17. Which of the following features most likely distinguishes common and preference shares? So as a reminder, common shares are going to be what you're typically just buying on the stock exchange. When you're getting ownership of a stock, you get the growth of that company and any kind of dividend payout there. On preferred shares, this is a different type of equity that a company can issue, but it comes with a more set dividend, but you don't get to participate in the full growth of the company, and you're higher up in the capital structure in the case of bankruptcy or liquidation. So that in mind, let's look at these answers. A, voting rights. So this will be our answer. And simply because common shares have voting rights and preferred shares do not. B, perpetual maturity dates. We can rule that out since both of them will have perpetual maturity dates. And then C, presence of embedded options. Again, both of these can have embedded options in them for preferred shares or common stock. Answer A. Question 18. Which of the following index weighting methods requires an adjustment to the divisor after a stock split? A, price weighting. Yes, this will require some adjustments. So when we have a price weighted index, the stocks are weighted based on their price. So if you're a $100 stock, you would have a higher weighting in the index versus a $50 stock. So when you do a stock split, that changes your price, and so that's going to have an effect on your weighting. So if you were to go off that example still, if you were a $100 stock, you had a higher weighting than a $50 stock, but if you did a 2-for-1 split and you're now a $50 stock, you're going to have the same weighting as that other stock. Let's make sure we can rule out B and C. So B, fundamental weighting. This would be incorrect because this is going to go off something like earnings or sales or cash flows, and that's going to lead to how the index is weighted. And changing the stock price and shares outstanding won't have any effect on the fundamentals. And then market cap weighting, this is also going to be incorrect. The stock price is going to change the price and number of shares outstanding, but the market capitalization will stay the same, so it won't affect the weighting. So we will stick with A, price weighting. Question 19. Which of the following industries is least likely cyclical in nature? So our cyclical companies are going to be more economically sensitive to the changes in the economy, and non-cyclical will be less sensitive. So in the case of non-cyclical, which is what we're looking at here for least likely cyclical, this kind of means that whether the economy is good or bad, people are going to be buying similar amounts of that good regardless. So that in mind, let's take a look here. A, autos. So autos are typically very cyclical. In the case of kind of on the consumer end, if people are losing their jobs or have less income coming in, they're probably going to be delaying car purchases since it's a very large part of your budget typically, or they may be buying older used models. Either way, that kind of makes this industry more cyclical. And on the flip side, when things are going well and people are making more money, they're more likely to go out and kind of spend more money on those bigger budget items. B, utilities. This could certainly be our answer. Looking at utilities, again, from kind of the consumer perspective, whether you are making less money or lose your job, you may turn down the heat in your house a little bit or something like that, but you're not going to turn off your heat. And so regardless of whether the company, or regardless of how the economy is doing, you're still going to use this service in some capacity. So there's going to be way less variability in a utilities sales and earnings relative to something like cars. And then C, technology. This is also going to be relatively cyclical, and this is more so from a business standpoint. When things are going really well, companies are more likely to invest in technology, make those investments to kind of help growth along in a good economy. Whereas when economy is not doing as well, they're probably more likely to kind of cut back on this type of stuff, that type of investment, to save on costs and make sure that they're kind of able to conserve cash and meet minimum obligations. So we'll go with B as the least cyclical in nature, utilities. Question 20. Which of the following is most likely the use of Herfindahl-Hirschman Index, HHI, used in industry analysis? So I'm going to pull in that formula here, and we can talk about what that is. So this S2 or S1 squared plus S2 squared plus S3 squared and so on, the S variable represents the market share percentage of a firm, and we express it as a whole number. So we basically take the top firms in an industry, and then we take their market share and we square them, and then this HHI number tells us kind of how concentrated that industry is. So an HHI, as a reminder, an HHI of below 1,500 means the market's very competitive. Between 1,500 and 2,500 is moderately concentrated, and then above 2,500 is highly concentrated degree of concentration between the top companies, essentially. So that in mind, let's look at these answers. A, measuring profitability of the industry. There's nothing in here about profitability. It's all about the industry concentration. B, calculating the historical growth rate of the industry. Again, we can rule that out. And then C, measuring the degree of industry concentration. That is exactly what we're looking for. Answer C.